as I said before, there are two big differences in the method. So we have some kind of absolute valuation, and also we have relative valuation. So in this kind of so-called absolute valuation, we are going to focus on the innate nature, the fundamental characteristics of the company. And from our point of view, from the point of view of finance, the fundamental characteristics can be the fundamental nature of the company can be characterized by its cash flow. So we are going to calculate the cash flow, and we are going to calculate the discounted present value, and we are going to aggregate, and that will be the company's value or the enterprise value. So in this procedure, for every year's upcoming, you need to get the free cash flow, or in other words, also known as cash flow from assets. And this free cash flow has three components: the operating cash flow, capital expenditure, and finally the change in net working capital. And because you are now, I believe, you are now familiar with this calculation, let me just review the process by looking at another company. In this example, Fallin Fancy, it makes cat toys, and let's just assume that it will operate only for the 5 years, then it will be liquidated, it will be gone. And for the each year, we have sufficient information such as EBIT, the depreciation, capital expenditure, and the change in net working capital. And these are given like this. So based on the information provided, we can have pro forma, or the projected calculation of the free cash flows each year. And we have operating cash flow, capital expenditure, and change in net working capital. And by aggregating these three components, we can get the free cash flow each year, which are 6.2, 7.1, 8.2, 9.4, and 10.8. And at the same time, in the previous chapter, in chapter 14, we learned that these free cash flows should be discounted with respect to the weighted average cost of capital. So this is also given as 8%. And now we can calculate the aggregated value of these free cash flow. And this will be 6.2, 7.1, 8.2, 9.4, and 10.8, but divided with respect to a relevant discount factors. So this is the first free cash flow. It occurs after 1 year, so we have 1 plus 0.08, and this 8 comes from the fact that the weighted average cost of capital is 8%. And the second free cash flow is discounted, and again with the same number but with the power of 2. And the third one has the power of 3, power of 4, and power of 5. And then we get the value of Fallin Fancy as $32 million approximately. And that will be the end for this example. However, this is very awkward. Why? We have unrealistic assumption that this company will last only for the 5 years, but we are not going to care about the years later, 5 years. So we don't care about 6th year, we don't care about 7th year, we don't care about the 8th year, and go on. So this is unrealistic because in reality, we believe that companies will continue to operate. So we have, in other words, we have going concern assumption, then we should think about the futures as well. So we may need to consider 6 years free cash flow, 7th year free cash flow, and so on. So that requires a lot of calculation for us because we have to make the pro forma statements for the 6th year. We have to make pro forma for 7th year, 8th year, 9th year, 10th year, 11th year, again and again. And there are infinite number of years for this company, and practically it is not possible to do so. Therefore, we are going to make a kind of approximation, and then we are going to just use a simple formula to get the values from the 6th year to the end of the time. And that will be called as the terminal value because that will be the terminal for our calculation. So that will be the end of our calculation. So this is the approximation in the far future. So how can we make an approximation? We can rely on what we already have learned, which are going perpetuity formulas. So let's remind, this is a reminder. So when there is an investment and it continues to produce the cash flows, but these cash flows will grow at a constant rate, and then the present value of the investment can be calculated based on this formula, C times 1 plus G over R minus G. Here, C is the initial cash flow, G is the growth rate, and R is the discount factor, discount rate. So, let's go back to the Fallon Fancy example. And now we are going to make a more realistic assumption. So it will continue to operate even after 5 years. However, instead, we are going to assume that the free cash flow will now be constantly growing at 2%. Then we can get the terminal value using the perpetuity formula as $184 million approximately. However, here please note that in this calculation, we are using several numbers. Here 10.8, this was the free cash flow in year 5. So let me write down the numbers. So we know what will be the free cash flows from years 1 to years 5. So we have 6.2, 7.1, 8.2, 9.4, and 10.8 in year 5. But we don't know about the far future. We don't know what will happen from years 6 to the upcoming years, and therefore we used this approximation, the terminal value, and the terminal value is calculated as, this is the terminal value, is 10.8, so this number times 1 plus 0.02, this is the growth rate, and 0.08, this is the same weighted average cost of capital minus 0.02, which is again the growth rate. And it gives us $184 million approximately. And then when we use this formula. This is about calculating the present value of a growing perpetuity, but in this formula, the situation is given like this. So we get the present value of these cash flows. And that means this terminal value is actually calculated, it is given as if we are on year 5 already. So when we get this number, this is not the present value actually. This is the present value when we believe we are already on year 5. So therefore, we should make another discount to get the actual present value. So because this is calculated on the assumption that we are on year 5, we need to discount 5 times because we have 5 periods to that time. So therefore, what we can have is this revised calculation. So the others are the same as before. So we have 6.2, 7.1, 8.2, 9.4, and 10.8. However, at the end of the calculation, we now have the terminal value, and this should be discounted with respect to the 1.08 to the power of 5. And then we get the present value of this company. And this value will be called as the enterprise value. So by the term enterprise, it means this is the total value of the company. And remember, where does it come from? The enterprise value comes from the free cash flows. And the other name for these free cash flows is the cash flows from assets. So practically, actually, the enterprise value is the same as the value of assets. And if we remember the balance sheet, we have asset on the left side, and on the right side we have debt and we have equity. So the debt plus equity should be the same as the asset. So when we want to calculate the enterprise value, that's the end of your calculation. However, generally, in most of the cases, what you want to get is not the enterprise value themselves, but you want to get the stock price. Because from the point of view of investors, what you are very interested in is the stock price. So therefore, from this enterprise value, you should get the stock price, and that can be easily obtained if you remember this equation. You have asset, and if you deduct that, and you get the equity. And the equity is the stock, so the stock price is this equity value divided by the number of shares. So therefore, the fair stock price should be V, the enterprise value, minus D, the value of debt, divided by the number of shares. So in this fancy company, if it has $40 million in debt, then you can calculate the stock price by using the enterprise value of 158 minus 40 million debt divided by the number of shares, 3.5 million. So you get $33 or $34 per share. So this is the discounted cash flow valuation to get the stock price. Before we move on, let me talk about some issues in the terminology. So in this slide, I denote this as the fair price. So what is fair price? So actually, a fair price is a franchise in Singapore, but the fair price in economics or finance has a different meaning. So the fair price, the meaning of the fair price is that if our analysis is correct and if we have sufficient information, that should be the price of the stock, and that is what we can expect. But it is not the same as the current price or the actual price. So in many of the cases, you would realize after thorough analysis, you get the fair price, but this fair price is different from the actual stock price. Then maybe you would wonder if your analysis was wrong. However, we often can argue that there is a point. So if we get the fair price as the current price, then that's actually the bad case. We actually want to have a different fair price from the current price because it gives some implications for us as investors. So we can have two cases. First, the fair price is higher than the current price, and second, the fair price is lower than the current price. And let's say the fair price is higher than the current price. Then that means the following. So if we had sufficient information and if our analysis is correct, then according to our analysis, the stock price should be this level. So say the fair price is $20 per share, but the actual stock price is currently only $10 per share. Then it means there are something that other investors are missing. So for some reasons, investors do not aware about the fair price, so they just make transactions at this level. So they are buying at $10 and they are selling at $10. However, we are superior, we are having more information and we have more skilled analysis, so therefore we can outperform them. So we can make fortune in this, we can utilize this advantage because others are not knowing about the fact that the stock price should be $20 in the near future. So therefore, what we can do is to buy the shares at $10 and we wait. And then if we are correct, if we are not wrong, then the stock price should go up $20 in soon. Maybe after 1 week, maybe in a month, maybe after a year. But then we can realize some of the returns. So we buy at $10 and we sell at $20. So we can get $10 return per share. And if the current stock price is $10, however, if according to our calculation, the fair price is $5, then we can have opposite transaction. So we can sell the shares at this moment, because at this moment the stock is overvalued. So we are selling at $10, which should be $5. And then later the stock price will go down, and then maybe we can repurchase the shares at a relatively lower prices. Or another strategy is the short selling. This short selling is another investment strategy, and this is selling the shares even though you don't possess the shares. So in this typical short selling process, first you sell your shares and by borrowing the shares from someone else, and then you get $10, and using the $10 you can purchase the stock at $5 later and give the shares back to the lender, and then you earn $5 as the return. So this is a strategy that can be utilized if you are confident that the stock price should go down. And global financial institutions, they engage in short selling a lot. However, for some political reasons in Korea, nowadays the short selling is just partly forbidden. So Korean students cannot do short selling at this moment. However, other international students can do short selling in your own country. So anyway, whether the fair price is higher or the fair price is lower, you can have some implications. You can have some intuition about what you should do as investors and how to make money out of the stock market. So that's why a lot of analysts are participating in this valuation every day. So that's why they are trying to provide us some of the stock prices. And according to their suggestions or recommendations, many investors are doing their transactions in the stock market. So that's why the valuation is very so important in terms of the investment in the stock market. Okay, so far we talked about the discounted cash flow valuation, but now let me move on to the second category of the valuation. So the discount valuation is theoretically perfect. It is the answer if you have sufficient information. However, practically, it requires a lot of information, and it may not be possible for the individual investors, because in the discount cash flow valuation, you need to make pro forma, which are the suggested or the expected financial statements for the upcoming years. So in the previous example, we were able to do the discounted cash flow valuation because we knew that what will be the free cash flows from years 1 to years 5. So if without this information, you cannot conduct the discounted cash flow valuation. And actually, in many cases, you don't have. So we may need alternatives. And that's the relative valuation. So because you don't know the precise cash flows, you can alternatively rely on the comparison. So you want to compare your target company with others, and by doing so, you can guess, you can estimate the value of the target company. And in this relative valuation, a very big assumption, the underlying assumption is that there will be similar companies with similar characteristics. So let me give you this example. So let's say there are 3 different companies, A, B, and C. However, interestingly, they produce exactly the same products in the exactly same way, and they sell those products at the exactly same prices to the consumers. Then there is information given, which are the revenues of 3 companies. So A sells 400 million, B's revenue is 200 million, and C's revenue are 800 million. And we want to know the value of B and C, but we do not know about the precise information, what happened inside the company. However, we know the fact that at this moment, the company A's value is known as $2 billion. And then, all else being equal, because these are simple manufacturing companies, we can assume that the value will be higher if the company sells more. And therefore, we can make this equation. So the value of A was 2,000 in terms of million, and the revenue was 400. So therefore, we can guess that the value should be 5 times larger than its revenue. And we know that the B's revenue is 200, and we also know that the C's revenue is 800. And then B's value should be 5 times larger in a similar way with respect to A. So it is 5 times larger to the revenue. So the B's value should be 1 billion. And the C's value should be 5 times larger. So it should have $4 billion as its value. So this is the principle of the relative valuation. So if you know that certain companies are similar, and if you also know that there is a pattern, then you can get the value of these companies. So let me give you a more formal explanation. So if you want to apply the relative valuations, then there are 3 things you need to know. First, you should choose adequate characteristics. In other words, some kind of financial ratio that represents the performance of the company. And second, you should select their benchmark. You should select their competitors or the companies with similar characteristics. And finally, you can get your target company's financial ratio, and then you can apply the relative valuation. So the first part, the frequently used financial ratios, let me introduce 2 most popular ones. First, price to earnings, and second, EV/EBITDA. So let me begin with the price to earnings. But in a nutshell, these two ratios have something to do with the estimation of cash flows. So remember that in this discounted cash flow valuation, what we emphasized was that the value depends on the future cash flows. So therefore, similarly, in this relative valuation, we assume that there is a kind of correlation with the value between the value and the free cash flows. However, we don't know the precise cash flows, so instead we are going to rely on the accounting measures such as the net income. So to understand the price to earnings, you first need to know the earnings per share. So the earnings per share, or the EPS, is calculated as the net income divided by the number of shares. So here in my slide, NI represents the net income and N represents the number of shares. And then the price to earnings is the stock price divided by the EPS, earnings per share. And very interesting thing is about the market capitalization. So there is a term known as market capitalization, or MC in my slide, and this is the market value of equity, and therefore it can be calculated by the stock price times the number of shares. So for example, if stock price is $10 per share, and if we have 1 million shares, then the market capitalization should be $1 billion. And this represents the market value of equity. And then you can see that by reversing the market capitalization, the stock price is same as the market capitalization divided by the number of shares. And then the price to earnings is the market capitalization divided by the number of shares, and EPS is net income divided by the number of shares. So in the denominator and the numerator, we have the same factor, so we can cancel out each other. So therefore, what we have is that market capitalization over net income is the price to earnings ratio. So this is the second equation here. Price to earning is defined as the price divided by the earnings per share, but at the same time, this is also market capitalization divided by the number of shares. The net income. And the rest of the procedure in the relative valuation is so simple. So because the price to earning is the price divided by EPS, reversely, if we want to know the price, it should be the PE ratio times EPS. The price equals PE times EPS. This is a very simple algebra. And the problems are, which are these numbers? And usually, for this financial ratio, we get this from the benchmark. In other words, from their competitors, except the target itself. And we obtain this EPS, the performance, from the target. So if we have the pro forma statements, then we can use the EPS from that pro forma statement. But if we don't, we can just use the actual EPS. And then by multiplying the PE ratio of the benchmarks with the target EPS, we can calculate the stock price. And secondly, if we are going to use the second part, then the market capitalization of the target company is again the PE times the net income. So again, this should come from the benchmark, and this should come from the target. So let me give you an example. So there is a company named Applied Materials, and its earnings per share is expected to be $1.07 in the next year. So this is the target pro forma, and then we also have the benchmark information. So the average P ratio of the companies in the same sector is 24.05. So we have the benchmark information, and then its fair stock price should be the benchmark PE ratio times the target, the EPS expected. So it should be $26 per share. However, in this example, it says actually the current stock price is only $19. So therefore, you can have an investment strategy here. So because the current stock price is lower than your estimation, you should expect that the company's stock price should go up in the near future. So therefore, you should buy the shares. So depending on what you get as the fair stock price, your investment strategies should be changed. So as you can see, applying the relative valuation method is very straightforward and very easy, very intuitive way. However, when you use the PE ratio, there are known some of the concerns. First, in terms of the EPS or the net income, so there is a problem. So in the calculation of the price to earnings, so we have net income or the EPS, and actually EPS is the net income divided by the number of shares, so it is also originating from the net income. So the net income is used. However, you should remember that net income is different from the cash flows. Net income is an accounting way of measuring the performance. So it contains a lot of noisy information, such as the depreciation. However, in finance, we want to focus on the actual cash flows rather than the net income, the accounting method. And second problem is that it does not talk about the enterprise value or the debt value. It just talk about the market value of equity. It just directly talk about the stock price. So the problem or the concern is that we can have the following situations. So we have similar companies with different level of debt. So one company is highly levered and the other one is less levered. But then we have different concerns. So highly levered company may generate more cash flows, but at the same time, it has a kind of risk because it can go bankrupted. Then it does not care about that characteristics. So to overcome these limitations, nowadays, a more frequently used proxy is the EV over EBITDA or EBITDA. So here we have EV, the enterprise value, and the enterprise value is calculated as same as we learned. It is the sum of equity and the net debt. And the net debt is the borrowings minus cash, because you can use your cash to pay out your existing debt. And at the same time, rather than using the net income, we are going to use the EBITDA, which is EBIT plus depreciation plus amortization. If you are not familiar with the accounting, you may be confused about the amortization, what it is. You can just think the amortization as a similar to the depreciation. So generally speaking, I'm not an accountant, so I may be wrong, but generally speaking, depreciation is about the fixed asset, the assets that you can see. For example, the facilities, the factory, the computers, the desk, and this building. These can be depreciated. And then you have assets which are unseen. For example, the patents, your technology, your research outcome, your goodwill, these are not visible. However, these are also assets. And these can be also depreciated over time. In that case, we call them amortized. So anyway, depreciation, amortization, they are similar concept, and these should be considered because depreciation and amortization is about accounting ways. However, these are not actual expenses or the cost. So therefore, we should make some adjustments, and EBITDA can help us. So to understand why EBITDA can give a kind of more precise information, you can think about the income statement. So we have an income statement. So we start with the revenues or the sales, and we have a cost of goods sold, and we have depreciation and amortization sometimes, and we get EBIT, earnings before interests and taxes, and we extract interest expenses, and we again extract the taxes, and what we get is the net income. So this is the typical structure of the income statement. in a general principle, then the problem is that what we want to have is the free cash flow. We want to have the free cash flow, and it is OCF, operating cash flow, minus capital expenditure, minus change in net working capital. But this is so difficult to understand the capital expenditure and net working capital at this moment. So that's why we are forgetting about the discounted cash flow valuation, and we are having a relative valuation. So let's focus on the OCF. The OCF should be calculated as EBIT plus the depreciation minus taxes. So here, from the EBIT, we ignore taxes and we consider taxes and we add back the depreciation, which was before the EBIT. So the reason that we ignore interest is because in finance, we understand interest as the payment or the compensation for the debt holders. So in terms of finance, this is not expense during your operation, but this is an outcome. And taxes, this should be cared because this is the actual payment. This is the actual expenses. But for the depreciation, we should add back because depreciation is not real one. This isn't just an accounting way representing that the value of assets will decrease over time. So therefore, we add back the depreciation. And then EBITDA is EBIT plus depreciation and amortization. So therefore, if we know the EBITDA, if we just ignore the tax part, then EBITDA should be the same as the operating cash flow. So that's why EBITDA is more important. It is more precise measure rather than the net income, if we are going to focus on the cash flows. So that's why in the United States, in most of the cases, analysts rely on EBITDA instead of the net income. So nowadays, rather than using the price to earnings, they often get their estimation based on this measure, EV EBITDA. So in the next Monday, during your case study, you are going to have a chance to look at this EV EBITDA measure. Okay. Before we close today's session, let me talk about the limitations of relative valuation. The relative valuation has advantages and also its disadvantages. Relative valuation is only possible when you can compare your target company with others. For example, you can not use the relative valuation if one company is a monopolistic one. For example, it is difficult, I'm not saying not possible, but it is really difficult to get the stock price of Google by using the relative valuation because there is no competitor per se. In a similar way, you cannot use the relative valuation to analyze Apple because there is no real competitor for the Apple. And you cannot use the relative valuation for NVIDIA, which is a manufacturer of the graphic cards of the company, of the computers. So the relative valuations can be used in a situation like there are many competitors, so there is a perfect competitive market and you can easily obtain the information about the competitors. But without the case, you cannot rely on the relative valuation. And second, sometimes some financial ratios or their performance measures are negative and you cannot use the relative valuation to get some meaningful results. So let me go back to the previous example of the price to earnings. And in this example, you are able to obtain a fair stock price of $27 because you have a benchmark from your competitors and you have your target company's information. But sometimes net income is negative. So it is incurring net loss. And then you cannot use the price to earnings because if you apply a negative number here, the stock price should be -1. However, there is nothing like negative stock price. The stock price should be always +1, like beginning from the 1 cent, right? So theoretically possible, but actually not possible in reality. So the typical example is the coupon. So for the international students, coupon is similar to the Amazon in the United States. So this is an e-commerce company in Korea. However, it went public, so its IPO was on the New York Stock Exchange. So it is listed in the United States. But when they started their businesses, they had huge losses because, as you might guess, this e-commerce requires a lot of investment. So you need to have platform, you need to have many consumers, and then it works. But when you are on the beginning stage, it is impossible to generate some meaningful income. So Coupang was incurring net losses every year from 2019 to 2021. However, they were able to have their IPO in the New York Stock Exchange in 2022, I guess. And at the time, it was really difficult to obtain the stock price of the Coupang based on the PE ratio because their net income was a negative number. However, actually, in the New York Stock Exchange, a lot of investors believe that this company has a high potential and they bought the stock at a higher prices. So it is not explained through the relative valuation. However, nowadays, in 2023, the last year, so it started to reverse and now it is making a lot of income nowadays. So sometimes you cannot apply the relative valuation and you cannot trust the results from the relative valuation method. And third, sometimes the market is strange. So when you use the price to earnings, especially, it is relying on the stock price information. And then the reason that we are relying on the benchmark is because we believe these are already evaluated by a lot of investors in the stock market. So we believe that this is a reasonable price. However, sometimes the stock market itself is not that reasonable. So remember the episode of COVID-19 pandemic. So during the COVID-19 pandemic, when the pandemic has begun in 2020, a lot of governments around the world and a lot of central banks started to lower their financial policy. So essentially in Korea, the interest rate by the Bank of Korea was 0. And also in the United States, the Federal Reserve set its interest rate as 0. And the government gave a lot of money to their people, the citizens, to help them overcome this tragic situation. And there was a side effect that in the market there was a lot of liquidity. So in other words, money was everywhere. So people started to spend it in different ways, not about their everyday lives. Instead, they started to invest in the stock market. They started to invest in the real estate market, and they started to invest in Bitcoin and other cryptocurrencies. So the price of the apartment in Seoul has become triple, and the stock price of the companies in Korea became doubled or even more. And the Bitcoin price, as you know, it became 10 times higher. So in these situations, people became irrational. So you cannot believe others' judgment. So you may have some bubbles or the bust in the stock market. In that case, it is really dangerous to just rely on the relative valuation method, because these stock prices are not reasonable ones. So then, what is our conclusion? First, it is recommended whenever possible to use the discounted cash flow valuation, because it will give you more precise and rational and fundamental information about the company's future. Then you can use the relative valuation method to complement the discounted cash flow valuation. Well, how? First, you use the discount-free cash flow valuation to get the stock price. And second, in an independent way, you use the relative valuation to get the boundaries. You calculate what will be the maximum possible stock price and what will be the minimum stock price based on the relative valuation. And check, finally, whether your answer from 1 is in the boundary of 2. Then, if it is in the boundary, it means you made a suitable or at least reasonable estimation from your DCF valuation. Otherwise, if your DCF valuation gives out of the boundary result, then it means there are some inconsistencies between these two methods. Then you may need to recheck your assumptions. Then, so by doing so, it will help you to make a more reasonable estimation of the stock prices.